Welcome to Wall Street Unfiltered. We're going to throw the mainstream gloss out the window. This 30-minute broadcast is targeted towards sophisticated persons. It's not for everyone because we're going to cut through the gloss and touch on insider issues that impact market environments, trading, and investment strategies. We're going to pack a lot of insight that points to where the future could be headed, and we're going to give warnings on current situations that are not getting the attention that they deserve. In this episode, we're going to touch on Fantex, which is a new investment vehicle targeted towards retail investors that allows people to get a piece of a professional athlete's earnings. Targeting a complex and oddly structured investment towards retail is sending mixed messages to professionals. Think this one through because there are some investment risks people inside this industry have never before seen. You're long a professional football player and the investment is being heavily marketed. There's some wild risk going on here, and I'm waving my Wall Street skeptic caution flag on this one, and I'll tell you why. One of the goals of this podcast is to put forth information that isn't being discussed in the mainstream, particularly if those topics have meaning for investors' futures. This is particularly the case with recent news that major banks, along with stock exchanges, have been hacked. But interestingly, the hackers didn't steal what was available to them, or they didn't do damage to the extent they could have. What does this mean? I bring in Michael Ide to discuss this and issues of artificial intelligence moving into the C-suite, doing the work of chief financial officers and CEOs. Speaking of trends, we're going to talk to hedge fund allocator Matt Osborne, who has a good inside track of what some of the algorithmic traders are up to. If you're a long-term value investor or a hedge fund trader, it doesn't matter. Algorithmic traders are important because their activity typically moves markets. With Matt, we're going to hit on a few behind-the-scenes topics. We're going to talk about the recent stimulus announcement in the Eurozone that was reported as a market surprise, but really wasn't a surprise to insiders. It was similar to when Janet Yellen announced she was going to start pulling back from quantitative easing in December. Jay Furstein, an algorithmic trader on the yield curve, is documented to have projected the move before the announcement. Another big issue I hear being discussed is, will the CalPERS decision to exit hedge funds become a trend? It's an important question, and I know derivatives exchange insiders are conducting a private study of institutional managers, talking to them at a meaningful level, and they're going to try and determine what's going on. Regardless of the results of that study, there's a case to be made that institutions who exit hedge funds now, as the withdrawal of QE approaches, might be selling on the lows. Matt makes this case and much more as he discusses the changing market environment with volatility ahead, and he has an interesting take on David Harding of Winton Capital and his QE analysis. That's a lot to consider in 30 minutes, so let's get right into it with the interview with Matt Osborne, Managing Director at Altegris Advisors. So Matt, welcome to the show.
Thank you, Mark, and thanks for having me.
Oh, my pleasure. Let's start off with the big news, if you don't mind. CalPERS pulling their money out of hedge funds. Were you surprised by that?
Yeah, Mark, it's a really interesting headline, and I think a lot of text is going to get written about it. And I think the big question to answer if you're a hedge fund manager is, is this anomalous or is this the beginning of a trend? I would tend to think that it's anomalous. CalPERS quoted in the press that three factors really drove it: cost and complexity and scale. And that last factor, scale, it was a $4 billion program and $300 billion of assets. It was essentially a 1.2% allocation, which is really unlikely to move the needle. So I guess I'm not surprised.
$135 million in fees on $4 billion in assets. Do the math. What also could be interesting is the point at which they're withdrawing from alternative investments. There's a case to be made as stimulus starts to unwind and Janet Yellen sort of defuses that time bomb without blowing up the world economy. Could they be making the wrong move at the wrong moment in history?
It's very possible. There's very smart people at CalPERS, so I'm not going to second guess their asset allocation strategy. I really do believe that they're their stated reasons are the reasons, and cost and complexity were quoted as factors. The cost issue is not just the fees, as you pointed out, but probably the cost of scaling an internal organization that will help them monitor and oversee the type of hedge funds investments they would need to make to have a material impact on their bottom line. In terms of their timing, look, we're of the view at Altegris that the end of QE here in the US will create a dislocation opportunity. Don't read that as saying we're forecasting a crisis, because we're not, but simply some of the factors we're seeing in the market essentially in the last month or so, where we're seeing that the end of QE and it will lead to a tightening cycle at the Fed. So it's not a question of if, it's a question of when, and that speculation around when creates some additional volatility and some opportunity for hedge fund managers to make some money where there just really hasn't been opportunity in the last few years.
Well, it's funny. If you're an algorithmically driven hedge fund manager who started to manage money in the past 4 years, you don't know what a volatile market environment looks like. So it'll be interesting to see going forward. Based on your projections of QE, projections of volatility coming back in the market, what kind of hedge funds do you like in the coming market environment?
Well, look, it's pretty well known that Altegris has some expertise in history and managed futures and macro, and that's certainly my personal bias and area of expertise. And I think that's those two areas, managed futures and macro, have been way out of favor in the last 3 or 4 years, really, since the glory days of 2008 for those two strategies, where they were the only strategies making money in a really drastic environment. We've seen the complete flip, Mark, and as you well know, managed futures and macro have been out of favor. I think that an environment where there's more dislocation between central banks, the Fed's on a tightening cycle where the Bank of Japan and the European Central Bank are still fighting deflation, that really creates some opportunity, particularly in areas like currencies. And Mark, currencies have been, almost dead in the water. I know the yen had a big move end of 2012 and into early 2013. But besides that big move, currencies have been really challenging for most macro and managed futures managers. And our expectation is that's going to be an area of excitement. And it's sort of begun as we speak.
The ECB really drove both the euro and the dollar on a nice, powerful trend. It would be really interesting if we start to see some trends come back into the markets. Tell me about some of the other strategies you work. I know you have a real estate long-short strategy. Can you give us a brief rundown of some of the triggers that drive that strategy?
The real estate long-short fund, Mark, is a 40-act mutual fund, and it's an interesting product because we work with a sub-advisor in that fund, American Assets Capital Advisors, located here in San Diego, who are an expert in real estate securities. And it was originally a hedge fund. They built up a 3-year track record on the hedge fund through the end of 2013, and we converted it to the mutual fund at the beginning of this year. We've seen a good steady growth in assets, so the fund's around about just over 60 million in size and growing nicely, and really helped by a fantastic performance year to date, where it's done well relative to peers. But the strategy is a long-short strategy. The sub-advisor believes that where we are in the real estate cycle right now is essentially innings 3 or 4 in the classic 9-innings game. So he's running a fairly long bias book, essentially running about 120 to 130% gross long with a 20 or 30% short side on any given day. So generally running about 100% net long, Mark, and has a fairly expansive description of what a real estate stock is, including, of course, REITs and companies like gaming companies who have substantial real estate exposure.
So is that how he gets his short exposure?
He'll short individual stocks and short individual REITs. Also run a interest rate hedge because we've shown historically that rising rates can impact the REIT market negatively.
There are a lot of managed fund guys who I've seen put on an interest rate hedge. There are a lot of hedge fund people that I've spoken with who are looking at quantitative easing. I've seen a lot of different models on potential rise in interest rates. Some of the volatility in some of the extreme models could be pretty dramatic. Going forward, in this coming environment, what's the top strategy that you think is going to succeed?
Make the case in my article that end of quantitative easing or coordinated global central bank intervention has reduced global volatility and did create an environment of increased cross-market correlations. And as that cross-market correlation has receded, we've seen an improved performance in managed futures and macro. In fact, we're on the cusp of 2 consecutive winning quarters here. My paper talks about expanding volatility, not necessarily high absolute levels of volatility. Remember that volatility is incredibly low. Volatility has been crushed by global central bank intervention. Volatility across an array of global markets is almost at all-time lows. So we think that for strategies like managed futures and macro investing, just an expansion of volatility, in other words, a reversal of the volatility trend, will assist those strategies because contraction of vol has really hurt. So just an expansion of volatility from very low levels will assist those strategies. And certainly we continue to be big fans of equity long short, where we have a good amount of exposure. And also we have, in particular, a fixed income long short fund that's done particularly well relative to peers, and we think is well positioned for a rising rate environment.
I'm going to take on a little bit of an issue here. David Harding has said that stimulus that the Fed has been putting on top of the markets, shouldn't impact managed futures performance. I tend to disagree with him. I think anytime markets are manipulated, it's going to do damage to trends. Where do you stand on that issue?
We're big fans of David and Winton. We have a large relationship with them, and disagreeing with David's probably a money-losing exercise on average over time. But I will take issue on this particular point, and I think that, to the point of my white paper, the cross-market correlations, we think, were higher in the risk-on, risk-off period that was really prevalent 2010 through 2012. And as we've seen global cross-market correlations return to normal, we're actually seeing the potential for idiosyncratic trends to break out across the landscape of managed futures, managers, and contracts. So, this year, for example, Mark, you've seen big upside in markets like, cattle and hogs, and big downside in grains, and really some material attribution on behalf of managed futures managers from some of those contracts, which we haven't seen for a long time. So, when cross-market correlations are lower, that sort of allows for an environment for trends to break out based on fundamentals in those individual markets, rather than the markets just flip-flopping back and forth on a daily basis based on the latest headline. And in our experience, managed futures does well when you have a lot of opportunity for individual markets to trend. So we think that with QE ending, this opportunity for central bank dislocation in terms of difference in direction, that's really a positive outlook for managed futures. And so I'll have to disagree with David on that particular point.
David Harding is clearly one of the legends, if not the legend, in the managed futures industry. If there's any one manager that I'd like to get in a foxhole with, I'd take David Harding's performance any day of the week.
Agreed.
So, can people get your white paper and learn a little more about your approach?
Well, thanks, Mark. Certainly at altegris.com, the white paper's there on the front page. It's entitled 3 Reasons for Managed Futures and Macro Now. And it's been a tough ride for investors in that space. And, there's been a lot of false starts and false hope for a recovery in performance. But let's not forget, Mark, that as you well know, the drawdown in managed futures and macro hasn't been that deep. It's just been the length of time that's been mostly frustrating. And investors have understandably become disappointed. But we're saying, hang in there, because now is an interesting opportunity, and that's available on altegris.com.
Well, thanks for joining us today.
Thank you very much, Mark.
Couple quick thoughts about what Matt discussed. If you're going to get into an investment like that, make sure you know what you're doing. There are a wide range of account options with different levels of transparency, fees, and liability. I like to correlate algorithmic strategies to market environments. It makes understanding the risk exposure much easier. And what's happening with quantitative easing is going to be very interesting to watch, as it has a related impact on the market environments to come. There are 2 macro events occurring that hedge fund risk managers are closely watching. The European Central Bank is moving into U.S.-style quantitative easing, and put quote marks around the words U.S.-style. This move is driving powerful trend, as is the success to which the U.S. can withdraw from the opiate of fiscal stimulus. These should be closely watched. Fed Chair Janet Yellen has a complex task ahead. Matt hit on the ECB move changing the market environment, and it's interesting to understand this. I wrote a few articles on what the big banks think is going to happen relative to ECB stimulus, and how it will shift market environments to various degrees. I was also fortunate enough to review a Bridgewater strategy note on the topic. Bridgewater thinks the degree of positive influence ECB stimulus will have could be overstated due to the lack of non-bank lending options in the region and the structure of the Eurozone business model. It's going to be important to watch these variables and how they play out as the U.S. Federal Reserve attempts to withdraw artificial stimulus and then the Eurozone sticks the needle in at the same time. Powerful trends, along with changes in market environment and volatility regimes, could yield opportunity for a lot of different trading and investing strategies to find success. One last point about the ECB announcing quantitative easing and mainstream gloss. This was reported as a surprise. Again, I'm putting air quotes around the word surprise because insiders weren't surprised. We reported about the potential move the day before the announcement, and the chatter inside the hedge fund circle was very strong months ahead of the announcement. Look at the yield on 10-year government debt instruments, particularly in the Eurozone periphery. Spanish 10-year debt had a lower yield than U.S. 10-year debt. This was primarily due to expectations that the ECB was going to inject artificial stimulus to numb the pain of free market rate rises on its economy. There are two ways to analyze bond yields. One is based on future inflation projections, and the other is based on market supply and demand and the risk of repayment in full. In the next podcast, we're going to have some insider government debt talk that explains what's ahead for investors. Speaking of fading, let's talk about Fantex and investing in the future revenue of professional athletes. If you follow our work on Value Walk, you know we've been writing a couple articles on Fantex. That's the exchange where you can invest in the future earnings of a professional athlete. I'm going to bring in Michael Ide, who's a writer at Value Walk. Michael has a bachelor's and a master's in physics, and he was an editor in Cairo, Egypt, just before the revolution took place. He's got some fascinating stories to tell, and he's currently getting his MBA. Michael and I are going to talk about Fantex, and we're going to take a look under the hood of this investment. We're also going to talk about artificial intelligence and some of the computer hackers that got into the big banks but didn't do anything. Michael, welcome to the show.
Thanks for having me. Yeah, I do think when we talk about Fantex, this is a really good example of the difference between speculation or gambling and actual investments. You don't really know what's going to happen. If your investment can have an injury and become worth nothing tomorrow, it's not really an investment, right?
It's speculation. And I see a couple additional issues here. Never before has an investment or a trade had the potential to be influenced by someone's personal misbehavior to this degree. If there's a scandal, an investor's going to lose money. Also, if there's an injury, the investor's going to lose money. And based on early statistics, Fantex athletes have shown a propensity to get injured. For whatever reason, I don't know. Now I want to raise another caution flag, my Wall Street skeptic caution flag. The investment's targeted towards retail. Anytime you hear an IPO being targeted towards retail or some great opportunity that Wall Street is allowing the retail investor to get involved with, be skeptical. That's my advice. Then there's an article in the New York Times that makes an interesting point. Investors may not have a direct legal right to the income and dividends. In other words, there's no guarantee. This needs to be investigated a little further. What's interesting, combine this with the fact that there have been suggestions on ESPN that athletes should be held to a different legal standard than everyone else. It's sort of like we're creating a super species of humans. Anytime you see a different legal standard being applied, check your wallet. Fantex looks fun. It looks interesting. It looks entertaining. But as an investment, I would just make sure you have all the details in front of you.
Yeah, I agree. Anytime you have something like this, we're talking about big-name athletes that people know. It's sort of like when we talk about big name stocks and they're sort of clearly overvalued and sophisticated investors are not interested in them, right? So this is something that it's almost designed to have mass appeal, and that worries me, just like you're saying.
Exactly. Speaking of being worried, we reported on J.P. Morgan and 3 other banks being hacked. Bloomberg did an excellent piece on the stock exchanges being hacked, and they were also the original source on these banks being hacked. And I see a couple trends here that we need to keep an eye on. First off, what interests me most about this hacking is that the hackers were able to get into the banks, look around, and it's almost as if they delivered a warning. They could have done dramatic damage, but they didn't do any of it. It seems like it's intimidation. It seems like they're saying, we can completely screw up your economy, but we didn't this time. You're being given a warning.
You know, the rumor is that this was sponsored by Russia, and no one's going to really confirm that. But I think it makes sense. If you have this gradual escalation, then getting in, rooting around, and not doing as much damage as you could sort of fits in that scenario of Russia backing an attack that says, be careful how hard you push us, or we may have to attack your financial institutions. So I think it sort of fits with the overall story.
Technology appears to be more insecure than ever. Our society is moving in this direction of the Internet of Things. So everything is going to be controlled. A car is going to be controlled by computers. There's going to be remote communication capabilities between cars, homes, and computers. To me, this is raising some red flags. One of the things that we cover a lot on Value Walk that I love to cover are stories about artificial intelligence, what's the impact there, and the fact that there aren't a lot of questions being raised.
Yeah, we have the recent attack on Apple Cloud, which shows just how people are becoming really used to technology being a part of their lives, and they're not really aware of how vulnerable that makes them in certain ways. But yeah, I don't see that trend changing anytime soon, even with these big negative headlines.
We wrote a couple articles on artificial intelligence doing some work in the C level. So a CEO, chief financial officer. Where do you think the job market's going with artificial intelligence?
I think that's definitely going to happen, not in the sense of replacing, but in the sense of augmenting. One example that's, I think, really interesting is freestyle chess, where, if I can use a computer and sort of offload the heavy computational aspect of chess to the computer and only make key strategic decisions, the places where a human is still, better than artificial intelligence, then I could beat a grandmaster in this way, or maybe not me, but a chess expert, someone that shouldn't win that match could.
I think there's a mainstream gloss right now that's being presented, so accepting of where we're headed as a society, and I haven't seen critical thinking on the other side of that argument.
Big question I keep asking me is, what happens when you simply have when you don't need workers, but workers still need jobs? And that is something that we're already seeing the effects of in the U.S., and I think it will spread. And we're just not set up for that, right? Our societies are not set up for large numbers of people whose labor isn't needed, and that will become a more pressing concern in the future.
I also think what's interesting is it might not just affect the worker, it could affect the elite in society, or at least certain levels of the elite.
One difference is, as long as the elites own the computers that are doing the labor for us, then it's hard to see how they would be affected, right? Like, some people live mostly off the things they own, and some people live mostly off the things that they do. And it's the second category that's really vulnerable to this displacement of labor.
You're getting an interesting point here. I think there's two types of elites. There are people who think they're elite, and there are people who are actually elite. I think the people who are actually elite are independent, have financial independence. I think a lot of people aspire to be in this elite category, but I think really, here's my judgment of an elite. Can you block a DOJ investigation, and can you block the media from reporting on it? If the answer is yes, then you're an elite. And I think that might cover 200, 400 people in the United States. If the answer is no, then you're not an elite, you're an elite wannabe. So that's how I look at that issue.
That sounds about right. I mean, I think there was a lot of people who have great jobs and make good money, and so they think that they're part of this elite that isn't being threatened by the technological trends we're talking about. And yeah, I think they're wrong. I think a lot of them, in 10 years' time, in 20 years' time, those jobs are going to come under threat. Yeah, I think the people right below sea level, I think that's sort of more the people who probably think that they're insulated, and they're not so much.
The people who think they're insulated and really aren't is the majority of that upper level. Anyway, Michael, it's been fantastic talking to you. I appreciate you coming on the show, and have a great day. That was good of Michael to come on and share his thoughts on artificial intelligence and computer hacking, two topics that aren't going away. As we wrap up this inaugural podcast, let me finish on a few notes. If you're going to be in New York or Chicago in October, you really need to check out Hedge Fund Rocktoberfest. It's a party hosted by the charity A Leg to Stand On. It's a great event. Essentially, hedge fund guys who play in bands get up on stage. The last time in Chicago, Jim Belushi got up on stage. But really, the cause it benefits is the most significant aspect of the party. The charity provides prosthetic limbs to underprivileged people who otherwise wouldn't have a method to survive. Mead Wells is the founder of Octagon Asset Management. He's also the co-founder of the charity, and he really tells a touching story. A young girl in Afghanistan had her limbs blown off, and as a result, she was treated like a leper in her village. Without limbs, she wouldn't have survived in this harsh climate. A Leg to Stand On went in and gave her prosthetic limbs so that she could live life and just basically survive. When you go to a party like A Leg to Stand On, it's fun and it's cool, but more importantly, it's an amazing charity event with good people behind it. The events are in October, so visit the A Leg to Stand On website at altso.org. That's altso.org, A Leg to Stand On. That about wraps it up for this inaugural podcast. If you have any comments, or if you disagree with anything, go on to Twitter and call me out. You can find me at Mark Melin, MarkMelin. Let me hear from you, good or bad, even if it's criticism. Bad is typically most interesting anyway. In our next podcast, I have George Haywood coming on the show. If you haven't heard of George, don't feel bad. George is a low-key, reluctant activist investor. He works from behind the scenes. He was involved in the XM-Sirius satellite merger, sat on the board for a while, but his real expertise, his passion you might even call it, is biotech. He's an odd activist because he believes in research and development, and he believes that medical discovery has a societal mission. If you understand activists, you know that this is a pretty unusual stand. Just take a look at what's going on with Valiant rolling up Allergan. George is going to talk about biotech activism, and I get him to reveal some developments in upcoming FDA announcements centered around particular drugs and different companies. Another thing we're going to talk about in the next podcast are algorithmic traders. They're important. They move markets. But typically, they don't get discussed in the mainstream much, and when they are discussed, most people don't understand. When an algorithmic trader gets into your stock, you want to know about it. Sometimes sophisticated investors can start to tell because the stock starts trading strangely. I'm going to break down a few stocks, and we'll talk about what is generally not much discussed. I'm sure there'll be a few interesting topics that come up in between now and then, so make sure to join us for the next podcast of Wall Street Unfiltered.